What if you had a way, maybe not a perfect way, but a probabilistically good way of anticipating market turning points? Today we discuss an approach conceived by the bright folks over at Verdad Capital. They show how, by more quickly spotting these market turning points, investors could more confidently adjust their portfolios to capture the opportunities and avoid the threats that have typified each new phase. Stay tuned as we discuss all this and more right now on the Retirement Lifestyle Show.
Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan Loungani, here as always with Adrian Nicholson and Erik Olson. We have an action-packed, exciting episode for you today that we're really excited to jump into. Erik, I have to ask both of you, actually, Erik and Adrian, first, real quick. How was Thanksgiving?
Adrian, how about it?
It was great. It was a lot of fun. Got to see a lot of family and friends. It was always a great time, just taking some time off and just catching up with some people that I haven't really seen throughout the year. So overall, it was just it's a really good time, and it's an even better time being here on the Retirement Lifestyle Show. I'm looking forward to it. Erik, how was your Thanksgiving?
Oh, it was fantastic. And as you might remember, I flew out to Seattle, my wife and I, and spent time with our eldest daughter's family and grandkids, and our youngest daughter flew out as well. And so we had just a ton of fun, especially spoiling the grandkids. It was great.
And I'll throw in a little teaser. If you continue throughout this episode, at the end, I'll mention a little surprise too that happened during the Thanksgiving break, just to hold your attention for this exciting episode.
Okay. How about you, Roshan?
Yeah, no, everything went well. I fried 2 turkeys. The first one was perfect. The second one, something happened where part of it didn't get cooked, and I need a redo for that to get that figured out and fixed. But yeah, everything went well. It was a nice holiday. Friday was rough with the markets dropping as they did on Friday.
Yes, that's right.
But yeah, aside from that, it was a nice Thanksgiving. It's definitely one of my favorite holidays. So
yeah, I know. So true. All right, well, why don't we get into it?
Yes.
Do you want me to introduce this?
Yes, please.
Introduce the topic? Okay, so folks, I want to say the conversation today is about the use of, I'll try to express this in sort of common language, trying to see whether or not there might be a kind of, even if it's a little bit foggy, a kind of crystal ball that will give us some sort of indication as to when to prioritize certain parts of a portfolio and to shave down other parts of the portfolio in response to what's taking place in the economy and in markets, and more specifically in investor psychology, and using investor psychology as revealed in something known as the high yield spread, and using that information that's as it's unfolding in real time to make decisions about portfolio allocations, and to do so if the crystal ball works. And of course, I'm using this semi-facetiously, but if the crystal ball works, it might be possible to actually dodge some downturns, or at least not fully participate in those downturns. But even more importantly, potentially, is when the opportunity is ripe to very opportunistically take risk and grab it by the horns and ride it higher. Then this particular approach that we're going to talk about today may be a way that gives us some insight into doing that. So we're going to talk about this particular approach and whether or not, in fact, it seems merely of theoretical interest, or whether it might have some practical application. Guys, is there anything you'd add to why that's important for people that are listening today?
No, I think that's a great explanation of it. I do want to start us out with explaining what the high yield spread is, and just really, to me, understanding what that is and the common sense sort of behind it makes this easier to understand. So first, let's explain that. The high yield spread is when below investment grade companies, so companies that essentially have lower credit quality can borrow money, what rate they're paying versus the U.S. Treasury rate. And if you have a low spread, which means they don't have to pay as much for these loans, that means money's available for them to borrow, which they can then invest and grow and expand. So to me, part of this, if you understand that, a lot of what we're going to discuss today will make sense, right? That if companies can borrow money, if companies that are considered at higher risk, which every situation's different, but in theory, if a company's higher risk, there is likely to be a lot of growth potential. If they are able to access money at a lower rate, they're able to then grow, and hopefully their growth rate is significantly higher than that rate of borrowing, and you'll get some growth. So I think if you understand that, that'll help line up the rest of our discussion. Anything to clear that up a little bit?
Yeah, I think I would just add to that as well. It's not only what's actually happening. You've done a great job of describing what's actually happening on the internal side of that company decision and whether or not to borrow and whether or not they think they have a useful way to deploy that capital that will earn a higher return on that invested capital than their weighted cost of borrowing that capital. But it's also profoundly important in what it reveals about what investors are requiring to be compensated for the risk of investing in those somewhat more speculative companies. And so that can vary a lot. And let's just give a couple examples. When the great credit crisis of 2008 hit, at the very sort of the most extreme stages of that, which I would argue were roughly December of 2008. Yes, it dropped. The markets dropped a little bit lower, but wow, they just got pounded in September, October, and down into December. Investors were requiring compensation of 22% or so more from these speculative grade bonds than they were requiring of treasuries. In other words, are you kidding me? You're telling me that you want to borrow money from me for only 3% more than what a treasury would pay me? Forget it. So then the companies would say, okay, well, what about 4? No deal. 5, no deal. All the way out to 21, no deal. How about 22? Okay. Maybe getting 22% more interest per year is enough to compensate me for taking on the risk of lending you some money that I may never see again. Okay, I'll do it. And so it's that revelation, if you will, about what investors are requiring and using that as a proxy about their fear and uncertainty or their confidence and perhaps overconfidence as a guide to where you ought to position your portfolio.
That's great observation, Eric. And I think it's also important to note too, another area that we're going to go into today is the different business cycle, different kind of market environment where you can kind of like look at this like indicator and see how you can use it, whether it's a kind of like a recovery stage or an overheating stage. I think that's going to be a really important area that you also consider when you're kind of looking at high yield spreads. And what Eric mentioned, how you can allocate different parts of your portfolio is going to be a big consideration with this. So it's a lot of great concepts we're bringing up, and I think it's going to be a really good podcast.
Yeah, actually, and Eric, Eric and Adrian, both of you, before we move on to that, I just want to highlight something because Eric, I think you did a better job explaining it than I did, because your perspective was better. I think yours was of the investor and mine was of the company. So I just want to touch on those, and then Adrian, if you want to pick it up from there and go into the different phases, we can move on to that. But Eric, what you said that I think is so valuable is it's how much an investor is requiring to get paid, right? So if we're looking at this spread and just think about this almost intuitively, if you as an investor are requiring 22% and I'm borrowing from you, I've got to have some really huge growth opportunity to pay you 22%. Right. And if I don't, I'll pass on the loan. So there'll be less money lent, and that means their money's harder to get, so to speak. So it's kind of both perspectives of the same thing. We're talking about the high yield spread, which a lot of it may be academic, but in just real world practice, It's how much does an investor want to get? How much does a firm want? How much is a firm willing to pay? And do they have the growth prospects? So if a firm's only got to pay 3% to get a loan, they only need a slightly 4, 5, 6% yielding in growth opportunity within the firm. They've got to pay 22. It better be something incredible, or they're not going to borrow that money, which will line up to these phases. And Adrian, do you want to go through those phases?
Well, let me just add one more piece before you do, Adrian, and that is, and so we've been speaking about this so far as sort of original issue of these bonds, but we should also acknowledge that a lot of bond market activity is in what we call the secondary market, meaning, let's say Adrian's an investor, I'm an investor, Adrian formally purchased this, and then the economy or the markets went to hell in a handbasket, and now he's ready to unload that bond. And so we could say as somebody considering possibly buying that off of him, I might be saying, rather than to the company, hey, you've got to pay me 22% more than a treasury would, I might be saying to Adrian, look, I'll only buy it from you. You're not the company. I'll only buy it from you if you'll sell it to me at such a price that my yield on that bond at the price I'm obtaining it is now 22% higher than I could get on a treasury. And at that point, if Adrian's saying, okay, uncle, I'm experiencing so much pain watching this bond decline as much as I have. Okay, I'll sell it to you at that point. You know, that transaction also is a powerful indication of what, at least, even not just the companies themselves, but other market participants are thinking about with respect to the fear and uncertainty factor, or again, feeling very peaceful and very confident. And that is a clue, because as Warren Buffett has said, and I'm not quoting precisely, but you know, the best time to buy is when there's blood in the streets, you know, or when everyone, it's something to the effect of, when everyone else is fearful, then you should be bold. When everyone else is feeling exceedingly bold, you should be fearful. What we're trying to ascertain is what's those moments in the market where the consensus of all the other investors has reached that point of extreme fear and pessimism, or conversely, you know, the other phases of their psychology, and using those as clues as to how to invest.
Yeah, and actually, the Buffett quote is be greedy when others are fearful, and be fearful when others are greedy. Although
okay,
I may have flipped that.
Much better.
But I love the blood in the street one. I had to Google it to look it up. That's because I knew I'd heard it before. That's Baron Rothschild, and they believe the original quote is, buy when there's blood in the streets, even if the blood is your own. Which
okay,
after the last, through 2 of the last 3 days being pretty bloody out there, it feels very relatable.
Well, great. And so anyway, by the way, as an advisor, I think there's value in what we're about, these 4 phases that we're about to discuss. I think there's value as well, because a lot of times clients are looking for, they hear such and such talking head say this or that, and then they start to get anxious, and they come to us as advisors and say, should I be blah, 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 with my portfolio? And I think having some sort of objective measure that can be quantified gives us at least a way of having a conversation about what has happened historically when conditions like this have prevailed, and on that basis, whether or not it's reasonable to be fearful and running away from risk, or conversely, whether it is reasonable to be running toward risk. Guys, yes. Your thoughts about that?
Completely agree. I think it's valuable for everyone.
Yeah, I think it's a great point. And then going back to those business cycles we touched on, I think this is like a really important part of just high yield spreads, where they can be a really good indicator for the business cycle progression. There are 4 stages: the recovery stage, growth, overheating, and recession. And depending on if a high yield spread is very wide, like we discussed, or very narrow, it can kind of help with kind of seeing where or what areas you should be allocating to, or consider allocating your money while you're looking at these high yield spreads. Some areas are small value companies, the S&P 500, bonds, treasury, gold futures, and this article even touches on oil as well. So I think those are all areas that are of interest to people where you can kind of use this high yield spread to kind of see where you should be positioning. I think is a really interesting area for us to look at.
So, Adrian, you mentioned for the first time an article, and that's a great lead-in. I would always want to give credit where credit is due. So
Yes.
there's a really sharp bunch of folks at a firm called Verdad, Verdad, and Dan Rasmussen there is the chief investment officer, and they publish on a relatively frequent basis some of the research that they're doing. And so back, if I recall correctly, this was in May of 2021, they published an article that the three of us found really stimulating and thought it would be worth sharing some of their findings with you. And then we've done, at least in my case, I've done some additional research that I think is also worth sharing with you. But so, Adrian, you started to define, or at least identify with labels, these four phases. You said recovery, growth, overheating, and recession. Let's talk about using this two ways of measuring spreads, how we segment into those four descriptive phases of the market. So I'm gonna tee you up here by saying it's either above the median spread for the last 10 years, or it's below the median spread for the last 10 years. And in addition, when it's above or when it's below, we can also ask, is that spread expanding or is it contracting? And so now we can say there are four phases, right? Right above the median and expanding, above the median and contracting, below the median and expanding, below the median and contracting. Do you want to get into what those four phases are using those two variables and what they tell us about psychology?
Well, so first, to all our listeners, we will be sharing the link to this article. It is definitely easier to follow if you've got the article in front of you because they've got the chart laid out. But now, please, Adrian, continue.
Well,
Eric,
I was going to go into what areas you can allocate if you want to continue with that, Eric, as well, because I think that's just really interesting when you kind of look at the breakdown with performance. It's really interesting some of the areas that do really well and some of the areas that don't do well.
Well, let me jump in and give the definitions then before you go to the areas.
Why don't you do that, Roshan?
So,
That's
so
good.
first is where the spread is currently. So once again, the spread is how much more a high yield or low credit borrower has to pay than the current treasury spot rate. So how much more they've got to pay. If that spread is falling, which means it's less of a cost for them to borrow the money, and it's above the 10-year median. So what's the average of that spread over the last 10 years, the median of the last 10 years? Well, then you're in recovery. And think about that. That makes sense. It's costing them less to borrow money. The business will then borrow money and invest in growth. If we're still above the median, but you're finding that the spread is rising, so you're above the 10-year, and now these businesses have to pay more, you're in recession. If you're below the 10-year trailing median, so you're below the average, and the spread is falling, so you've got to pay less for that to borrow that money, you're in the growth phase. And if you're below the median and it's rising, you're overheating, which means investors are now saying you've got to pay us more to borrow money, and you're below the median, but investors are requiring more. They're calling that the overheating phase. So those are the four quadrants compared to the spread. A little bit more detail on how they define the four stages. Recovery, they're saying there's a growth boom as the economy is restarting. Growth means you're in a sustainable growth period that could trigger inflation. Overheating is growth is slowing and inflation is going up. And then recession is growth is negative, as is inflation, and there's reduced consumer spending, rate cuts by central banks. That's how you're defining those areas. So Now we're going to move into performance and those different phases. But first, I've got to ask both of you, any opinions on where we are right now? What would your opinion be? Would you say we're at recovery, growth, overheating, or recession?
For the last 5 days, we've moved from growth to overheating.
That's your thought, and that narrows specifically to the last 5 days.
Mm-hmm. We shifted into again using their definition, which I found helpful. That looking back over the last 3 months is is that spread expanding or contracting? I, by the way, measured that using something known as a linear regression slope. Mm-hmm. So maybe others would use a different definition of, they might use point to point or something else, but using my version at least, which is a slope measurement, then in the last 5 days, the slope has turned positive, meaning now looking back to 90 days before, the spread, what investors are demanding of high yield bonds is starting to expand again. And we're below the median.
Yeah. So we're starting to see that now. You had said over the last 5 days, right?
Mm-hmm, mm-hmm.
So prior to those last 5 days, we were then in growth
mode.
And how long were we in growth mode based on your chart? Actually, if you have it in front of you, please share it, Erik,
sure,
so the audience can see this as well.
So
and then we'll continue on.
Our YouTube audiences, let's take a peek at this then, and I'll try to describe it. So you look on the far right-hand side of this graph, and YouTube audience, just you're seeing here 2 graphs, one overlaid on the top of the other. So this single orangish colored line that's weaving its way across these mountains and valleys, that's the median on a trailing 10-year basis of that spread. And then the mountain graph with the 4 different colors, that's what was the spread on that market day. So if we look on the far right side, what we see is that the area now is shifting into this gold. If you can maybe barely perceive it on your screen, I don't know if you can, but we had been in the growth phase here for about a month or 2 prior to this. We'd also been in the overheating phase probably for 2 months before that, roughly speaking, maybe 6 weeks or so. But we had been in a sustained growth phase, at least according to this, more or less coming out of the election and running into about August or September of 2021.
So why I think this data point is so important before we move on is just to show that these shifts can be pretty frequent, right? Mm-hmm. So I'm always, when we're going over something like this, thinking about, well, how can I use this indicator? And I don't know how realistic it is to jump from one versus the other. I'm cherry picking on this chart, but if you look at, Erik, the July of 2016, we've got an overheating phase that appears to last, 2 days? 2-3 days on there.
So yeah, July of 2016, and yeah, it's a very thin.
That's 15. Phase. Go to the right a little bit.
Yes. There okay. Yeah, you're right. Oh, see, you're absolutely right. I think you're right. Mm-hmm.
So how I feel this is useful, and for all the listeners, is very often I'll talk about using multiple indicators. We've discussed that at length before. Mm-hmm. I think this is a good one, but you've also got to figure out how you can use it, because I don't think it's reasonable to think that you can jump from one investment to the other for 2 days at a time, and just go back and forth that frequently. Now, please note that I picked a really short sliver, but there are a bunch of short time frames in there. But jumping back on, Adrian, I know you were really wanting to get into this, and I held you back. So let's go back onto the asset classes and so on. But as of right now, for the last few days, we've been in overheating, but we don't know how long that will actually last. So for everyone listening, think of the whole thing and don't necessarily make any moves on your portfolio because we've been in overheating for a couple days.
Yeah, that's a good point. I mean, that's one of the interesting aspects that you should really consider with this high yield spread is just like the overall turnover. That's a big consideration, portfolio turnover, just trying to reduce as much as possible, I think is something that you should just consider if you're looking at this, where if there's a bunch of changes constantly, you'll have to implement a lot of changes in your portfolio. So that's one aspect you should really look at.
Taxes when you're doing turnover, and then just monitoring and the frequency of adjustment. I think all of that, just thinking how you can actually implement is important.
Yeah, exactly. And then Roshan, you did mention that, and Erik too mentioned that we're kind of experiencing this overheating cycle right now. And the numbers, I can just go through the numbers right now, and then we can kind of just kind of discuss this. It's showing that in an overheating, the equity section, small value had a 11.9% return. The S&P 500 has 17% return. Investment grade bonds was 7.3%. 10-year treasury was 10.5%. Gold futures was 6.3%. And oil futures was actually negative 2.4%.
Yeah. So, and looking at that, once again, it kind of makes sense, right? If you're in the S&P 500, probably a company with getting better credit terms, you can borrow money cheaper than a small cap company that is so tiny they're not even in any of the indices. Now, this is using small cap value, but a small cap, meaning essentially a smaller company, would probably have to pay more to borrow money than a bigger company, especially when you hit the overheating phase. So then the bigger company should grow a little bit more, which we're seeing with the higher S&P performance in this overheating stage.
And I guess one question that comes to mind here, where this overheating stage kind of presents saying that inflation begins to increase. And like kind of one of like the stories that people talk about right now is bonds right now. Bonds have a hard time keeping pace with inflation right now. So a lot of investors are considering, like, if there's a lot of inflation going on, what role can bonds really play here for me right now?
Yep, another great point, right? If you're loaning your money to somebody, you don't want them to pay you back in less valuable dollars, right? Which especially, there was a lot of talk about this in even last year in 2020, but even in 2009 when the government was printing money and saying, well, they're going to borrow this money and pay it back with less valuable dollars because of inflation. But as an investor, you want to make sure your purchasing power, what you can use your money for, isn't lessened at the end of the term of this loan.
Well, I guess I think we should also, though, say the other reason that people own bonds isn't necessarily because they're looking for return. They're looking to avoid decline.
Yeah,
and
true.
so it's actually in the overheating phase that bonds are at their strongest of all the four phases, or at least have been over the period that we've measured. So clients, at least in my case, what the St. Louis Federal Reserve publishes a series that was developed by the folks at Bank of America, and this high yield spread gauge that they publish on a daily basis it goes back to the end of 1996. So based on the fact that we're saying, well, we're going to use a 10-year median, you can't really have measured a 10-year median, can you, until 10 years have passed from that point. So really the first instance in which you can make a comment, is this above or below a 10-year median, using that specific index, isn't until 10 years after that date, meaning specifically New Year's Eve of 2006. So if we go from New Year's Eve of 2006 till now, we're talking about a period of almost 15 years. And speaking strictly then about that 15-year phase, in that phase, the overheating moment is the best time to be invested in both investment grade corporate bonds as well as in treasury bonds.
Now, Erik, tell me if I'm reading this incorrectly, but to me, based on the 1990 to 2020 chart on the Verdad Post, investment grade bonds are at their best during recession and recovery.
Well, so I know. So I used a slightly different data set, and what they did in theirs is they went back and used because the high yield spread series that we're using here wasn't available then. they tried to essentially, and I'm not faulting them for doing this, they wanted to elongate the data set, and I think that's useful, but they took a different spread series and tried to paste the two things together. So let's use that and go with that. So your comment is that your advice, at least if you're following the 1990 to 2020 period that they're using, is you'd say, well, take hold of bonds in the overheating and in the growth phases. Is that what you said?
No, their data says recession and recovery are the best periods for bonds. But you're not looking at all of these are positive numbers, right? But their data set in growth has a 5.1 return, whereas during the recession phases, it's at 9. The treasuries line up similar to what exactly to what you're saying, which is overheating. They outperform. That's their bet.
Well, it's interesting how that's slightly different than for corporate bonds in those two phases. They're looking from 1990. I'm looking from 2006 forward. So I think that's actually really interesting. Interesting contrast. I think one of the other things that we should just mention here is that coming back to the Rothschild quote about investing, or the Rothschild and Buffett quotes about investing when other people are fearful or when there's blood in the streets or this sort of thing, is that think about the psychology of having just gone through a recession. People are rattled. People have seen, for the most part, in buy and hold portfolios, they've seen their portfolios decline. They're concerned, and they're thinking about saying, hey, stocks, I don't know when to get back into stocks. That's the common problem, isn't it? Figuring out when to get back into stocks. And what this particular approach seems to offer is a way of summoning some courage. And it does so by showing that, in particular, in the overheating phase, the phase in which many people still are holding back, they're still feeling burned, they're still feeling wary, they're taking a wait and see approach. That's at least the predominant view. They're kind of hiding in that scenario or in that psychological setting is a tremendous opportunity for those who are willing to seize it. What, guys, according to this paper and according at least to my research as well, what is that opportunity that so many people miss because they're still too fearful to engage?
A small cap value.
Small cap value. And specifically the returns that they identified in the paper. You're looking at the paper. I'm looking at my graph, and then they're comparable numbers. But if you annualize the 90-day forward returns for making a decision on day X, and then holding that position for 90 days, and then annualizing that return, what did they say in the overheating phase was the annualized return to owning small cap value?
Well, no, so their time frame to get in this is recession and recovery.
Did I say overheating? I meant to say recovery.
Yeah, so in recovery is where you get the biggest difference. You've got 39.3 in small cap value and 13 versus 13.7 in the S&P. So you're talking a little under 3 times the returns.
Yeah. So I mean, I don't know about you guys, but I was really affected. My thinking was really affected by this paper and then by doing this research, because I think my outlook has been, hey, small cap value has phases. It's hard to discern necessarily which of those phases it's going to thrive. But since in the long run, it outperforms large companies, then it's useful to have a dedicated allocation to small cap value and just make that sort of an ongoing part of your allocation. And what this suggests to me is, oh my goodness, you don't need to necessarily have a permanent allocation to small cap value, but during those recovery moments, it's extremely important, or valuable at least, to make a significant move into small cap value. How did this affect your thinking in a similar way?
It did, and it also got me thinking about just what's happened this year, in the last, I guess, couple years, almost 2 years now. But during the pandemic, I'm thinking specifically in March of 2020, and I have not pulled the data yet, but I believe small cap value crushed it coming out of that decline. So it's taking it to a real life example. I think we saw it happen just a little over a year and a half ago, or roughly a year and a half ago.
Yeah. There's another interesting, I think, component of this, and that is if you just look back at the actual dates. So let me just find the actual dates as we talk about some of these moments in the market. So let me just pull my graph is unfortunately obscuring things right here. Let's talk about the switch date on some of these approaches. So I've said that the last 5 days have essentially been in this stage of overheating. That's okay. We'll find out for sure whether or not it stays there. And I do want to come back actually to your implementation question for just a moment. But when I look at this, and I go back to where things stood, kind of at the depths of the or actually as we entered into the market response to this sort of unfolding awakening that, wow, we're dealing with this whole coronavirus thing. It's just spreading, and suddenly the market starts to react. The market shifted without even going through using these definitions from a growth phase to a recession phase without any sort of transition through an overheating phase on February 28th.
So February 28th, their indicator is growth.
On February 27th, you would be in growth mode. February 28th, the very next day, you leapt from growth to recession.
And when did it flip back?
When it stayed in recession until May 31st, and then on June 1st, it jumped over to recovery.
Now, recovery is the small cap. I'm actually looking at a chart right now. Recovery is when small cap is supposed to outperform. When does that recovery end on that chart?
The small cap recovery went through November 4th.
November 4th, 2021. So May
2020. These are all 2020 dates.
Okay. So let me compare this right now. November 4th, 2020. And as I get there, I will share this screen because I've got it up. And while I'm trying to get us there, I've got I've got the Vanguard Small Cap Value Index ETF up.
Mm-hmm.
And I've got the S&P 500 and up. And
well, while you're pulling that up, let me just make this comment. So I'm not saying, again, I want to be very, very cautious about saying this is a crystal ball, but I think it is noteworthy that if you had substantially left equities on February 28th in response to that February 28th of 2020, when we're not talking about 2021 now, and you had stood aside until June 1st, and then you had gotten back into small cap value and stayed overwhelmingly in small cap value through just the essentially election day, you would have, and measuring all of that period as recovery, you would have dodged a lot of downturn in response to COVID, and you would have captured a lot of upside as part of that overall recovery. I mean, that would have been that series of trades, and you can't overgeneralize from sort of one story, one anecdote, but nonetheless, I would say it's pretty impressive. Again, if we're using this as a signal of investor psychology, that it was reaching this stage of tilting from growth suddenly into this recession, and then from recession to recovery at precisely those dates, you would have done quite well.
Well, and I pulled the chart, and I wanted to start here. This is their article, and you see that's the recovery phase, right, which was June 1st to November 4th of 2020.
Mm-hmm.
And it says small cap value at 39.3 during these going back from 1990 to present versus the S&P of 13.7. Well, what's interesting is when you actually pull that up just for that time frame, the S&P won 15.1 versus 12.3. So going back to my point earlier of you can't just sort of blindly follow these things, use it as a data point. This is one instance where it would have been better for you to be in the S&P during that time frame versus small cap value, even though the historical time 1990 to present indicates the opposite.
Yes, and I don't think that the point here necessarily is that it will always be the case in every point to point on recovery or any of the other phases that the predominant pattern holds precisely. But you would agree that small cap value performed admirably well in that phase, would you not?
Right. I was actually trying to make the point you just made as well, that well, not only that it's not going to be exact, but when you get back to how you can utilize this in the real world, I just don't think you can take this one paper, though it's well written. I like the research and so on. You just can't take this one thing and say, okay, I'm going to manage all my investments based on this from now on.
Agreed, fully agreed. I think we're talking about propensities and the preponderance of data rather than necessarily this law somehow of the markets that in the recovery phase, small cap value will in each and every instance always outperform every other of those 6 asset classes that we've looked at.
Well, and that their data indicates the same thing. Average across all cycles, small cap values at 15.4, S&P is at 11.6, investment grade bonds at 7.1, 10-year treasuries at 6.5. Gold futures 4.9 and oil futures 8.3. I know those were just a lot of numbers, but the point is those are their average rates of return across all 4 phases. And as Erik just said, small cap value tends to outperform, which is an argument to just having an allocation towards it ongoing, as you mentioned earlier.
So I have 2 other topics that are kind of connected to this that I think are interesting to me. Let me just introduce them, and then if you want to go a different direction, we certainly can. But one is you've asked the question about implementation of these ideas, and you've emphasized you wouldn't do this whole hog with your entire portfolio, which I completely agree. But if you said, I'm going to do this with a portion of my portfolio, I have an idea about the implementation question that doesn't involve all of the dramatic switches that you pointed to, at least in the period where it's sort of phases between growth and overheating, growth and overheating, growth and overheating, especially since the prescribed portfolios, if you use the performance differences in those 2 different phases were your guide, it could get to be a lot of choppy activity.
Yes.
I will hasten to add, though, that I think when you enter into those recession phases, it might be from an implementation standpoint worth being pretty following through on the conviction there and just getting right to it. And because it seems like when it gets into the recession phase, at least on the historical work that I've done on this so far, it persists there for a while. It's not just usually it's not just a couple months thing. It goes for a while. And similarly, the recovery, yes, there are some short recoveries, but most of the recoveries are somewhat more of longer duration, long enough that you're not going to get hit with a bunch of switching costs, and you can stay invested. So I might have a different policy between a little bit more gradual approach to switching in the growth overheating, but be more decisive on the entry into recession, entry into recovery. Your thoughts about that?
I like that approach, and that's the point I was trying to share with the listener, right? You've got to take this data and learn how to use it within your approach, right? Because just jumping all around, and that's part of the reason I like to rely on multiple strategies. They talk a lot in this paper about, they have one section that I'll mention that I think lines up well here, is that it's they talk about the lost decade, where you had between 2000 and 2010 almost no return in the S. It's 2.8% over those 10 years for the S&P 500. Then they compare their strategy which is a little over 38%. During that time frame, a 60/40 portfolio, which is at about 7.3, and then they compare it to inflation, which during that 10-year time period was at 4.8. So what they've done is compared different strategies to theirs, and they'd said, well, hey, if you use this, it helps you avoid the lost decade that existed in 2000, 2010. My argument to that is, well, this may be one of your strategies, or you may take a little bit of their research and put it within your strategy. I just don't think you should have only one.
Oh, I completely agree with that. If anyone's taking from this that they should suddenly use this as the basis for making decisions about their entire portfolio, I think I agree with you. That's mistaken. So we've talked about...
You said you had two things, Eric.
Yeah, so implementation is one. The second part of it is just the practical application of this in the client-advisor relationship. So I had mentioned that I think a lot of times you hear just a wee bit of bad news, and there are going to be at least some subset of clients who will say, hey, is this time to head to the exits? Do you get that very often?
Fortunately, not too much, but I have, I'd say one or two.
Okay. Well, so I usually think of those one or two that are the most vocal about it as sort of the, not merely the canaries in the coal mine, if you will, but they are probably the more vocal representatives of a larger body of thought that exists in my client base that's just unarticulated. And a lot of times, there's a saying, we can use all sorts of maxims and adages with our clients about, and to try to tame fears, that sometimes surface from moment to moment. But I think there's nothing quite as good, those adages and maxims such as, hey, markets climb a wall of worry. So, if you're feeling worried, that's probably a good opportunity for, to stay invested, or, whatever the case might be. And to have some sort of quantifiable and actually graphically visual way of having a conversation with the client about where we are right now and how other periods like this have actually behaved, I think helps people say, okay, it's not just my advisor trying to talk me down, talk me off off the ledge. What they're really trying to do is to use data to kind of give me an informed perspective on what a reasonable emotional response to all of this is, and from that, then a reasonable action-based plan to all of this. And that's why I really value papers like this that have done the empirical work. But maybe you look at this differently.
No, I definitely find this as very valuable. And because if I didn't, I wouldn't be thinking about how could I use it, right? I'd throw it out. And we wouldn't be discussing it on the podcast, I think, if we all thought it was it was a big waste of time. But no, I think the information's valuable there, and this is not a new concept, by the way. The high yield spread is something that a lot of people look at and have looked at for a while to try to be an indicator of the future. So I do like this. I like what they've had to share. I would challenge how realistic it is to switch for 5 days from one to the other, right? But I like your twist on it, which was, well, just use this to help protect you in the recession phase and for the recovery phase, because those are the two longest. I think that's a very good way to take the data and find a real world application for it.
Yeah. Well, so let me just respond then, because you've talked about implementation there again, and the switching back and forth, and sort of the abruptness of it all. What I do in another of my strategies is I will call them decision points, and each of those decision points only governs a portion of the assets that are committed to that strategy. So it's not as if every snapshot of the market, daily, monthly, weekly, quarterly, whatever interval you use to take that snapshot and then make a decision, it's not as if then the entire portfolio committed to that has to swing over. And in my own case, for example, I do something that's every second, well, it's twice a month. And since it's twice a month and it's a monthly strategy, one measurement point only gets to dictate what's done with half the portfolio. If it were weekly and it was a monthly strategy, then I could say, all right, each weekly observation, each weekly snapshot only gets to affect its own fourth of the portfolio, and so forth. And so if you said you're going to just extend that principle down to a daily measurement of a quarterly strategy, then you might say on the measurement points, even if let's just use in the extreme that you made a daily adjustment, but you each day would only get to update 1/90th, or said different, since there's 63 trading days in a quarter, 1/63rd of the overall allocation. It would be a much more gradual shift from one phase to the next phase. That's why I was saying, though, that in the case of the recession and the recoveries, I might be more decisive than that, simply because it appears they are more sustained in each case than is commonly true for at least the overheating phase, which looks like it can fool you a lot.
Yes, and I think we're actually describing the same thing, right? Use this for only a portion or to govern part of the portfolio. Look at how you do it, and I don't think you said this explicitly, but there's more than one indicator, right? And in your example, it was varying time frames, but not just jumping in and out. So I like that approach. I like that approach a lot.
Well, hey, so guys, we've covered a lot of territory. I don't have much more to say about this except to just commend the paper to our listeners and identify that we'll have this in the show notes. We'll also have, as part of this, the data that the link to the Federal Reserve, the St. Louis Federal Reserve, so that you can see this data series and download this data series for yourself if you're so inclined. And you can do some of your own measurements and test some of these other things. And as always, for those of you who are looking for actual price data and performance data to various, whatever security you might be considering evaluating as an implementation tool for this sort of thing, I would also point you to the finance website at Yahoo, which offers historical daily data, and you can incorporate that into your analysis as well to do some of this measurement. So I don't have anything to say more about that, but I am curious about Adrian's teaser at the beginning of the episode. So is there any more thing that you have to say about this paper or about this subject before we hear from Adrian?
I don't, Eric, but again, this was a really great episode. I really like discussing the high yield. I think it's a really great indicator that people should really look at to see how it could be a part of their overall situation. What about you, Roshan?
Yeah, well, I just summarize what we went over. We will share the link to the article. We talked about the high yield spread, the four different quadrants that they have for the 4 different stages, how you can use it in your portfolio, and where you can do the research. Eric mentioned the Yahoo site. That's actually where I pulled the chart from. So I think this is a very useful topic. Oh, and Eric, you shared your data set earlier, but you pulled that from the FRED site, right? The Federal Reserve site.
Craig, so I'll provide a link to that, the St. Louis Federal Reserve, and I'll provide people with a specific link to the specific data set that they refer to in the paper, and which I believe, beyond just their viewpoint, it's considered the blue chip, is the best of the best indicators now that exists about the high yield spread.
Yeah, great source of data.
Awesome.
So, Adrian,
and I will get into it. My
Yes.
little teaser in the beginning. Thank you for making it to this portion of the podcast. I want to congratulate one of our listeners who happens to be my brother on getting engaged to his new fiancée, Kelly. So congratulations, Isaiah.
Congratulations, Isaiah.
Congratulations.
That's awesome.
Yes. That
Good
is
for
great.
you, man.
Couldn't let little brother get engaged without him.
I know we got engaged the same year, which I actually think is really cool. So
it is awesome.
A lot of good things coming ahead, and I'm really excited. Thanks for letting me share, guys, and thanks listeners for joining us today.
Yeah, and Adrian, I got to ask, your wedding will be October 2022. What
Yes.
about Isaiah?
He mentioned probably in 2023, but I don't think he has a set date
And
right now. But he's really excited. We're all really excited. We got to spend Thanksgiving with Kelly's family, so we all met them for the first time. So it was just very exciting and extremely happy and very proud of him.
well, congratulations to him and to the whole the entire Nicholson family. You've got 2 weddings in 2 years, so you've got 2 big years coming up.
Exactly. A lot of events coming up, but all good news and really happy about it.
Yeah,
That's
that
great.
is great. Great Thanksgiving. I didn't have any news that would compare, and Eric, I'm just assuming you don't either.
Not like
I'm just
that.
glad you didn't blow up your house with the fried turkey, Roshan.
Oh yeah, I measured. I made sure I was 10 feet or more away from the house and cooked it in the driveway. So safe distance. Yes.
So compliant. I love it.
Yes. Yes. And to all of our listeners, thank you again for joining us. This has been another episode of the Retirement Lifestyle Show. We hope you found this topic valuable and helpful for you. We'll be back next week with another great episode. Please like, subscribe, tell your friends, family, give us 5 stars. And this has been the Retirement Lifestyle Show.